All right, welcome to today's explainer. I'm putting on my expert investment analyst hat today because we're taking a magnifying glass to a stock that has the entire market completely divided. Picture a company with earnings skyrocketing 417%, revenue up nearly 50%, and trading at a really attractive price-to-earnings ratio of just 12.6. Sounds like the ultimate no-brainer energy value play, right? Well, today we're breaking down Valero Energy. At first glance, momentum investors are absolutely cheering. But underneath the surface lies a pretty fascinating mystery. If we run a complete stock analysis using the frameworks of the greatest value investors in history, they would likely run the other way. So let's put Valero through the ultimate valuation gauntlet and figure out exactly what's going on behind these numbers.
So let's just dive right into this massive contradiction. We're looking at Valero's staggering 417% earnings jump going head-to-head against its actual stock price. Valero's currently trading around $300 a share. But when you apply Benjamin Graham's conservative valuation formula, which blends earnings and book value to find a stock's true baseline, it gives Valero a Graham number of just $144. That means we have a stock price that's more than double its fundamental intrinsic value. How in the world can a company with explosive short-term growth be priced so far above what deep value math suggests it's actually worth?
Now, what's really driving this hype is the sheer momentum Valero generated in the second quarter of 2026. They posted a jaw-dropping $12.54 in earnings per share, completely shattering analyst expectations by 25%. I mean, when you're processing about 3 million barrels of crude oil per day across the globe, this kind of profitability makes you look like an absolute powerhouse. It's exactly the kind of flashy headline number that forces the market to pay attention. And hey, we absolutely have to acknowledge these massive green flags. This wasn't just a lucky quarter. Look at the structural windfall here. Net income hit $3.7 billion on soaring revenues of $44.5 billion. They generated a mountain of operating cash flow, $4.49 billion to be exact, and immediately fired $2.6 billion of that right back to shareholders. But the real kicker for growth investors, their renewable diesel business flipped a $79 million loss into a $717 million profit. Add in a nearly $8 billion cash buffer, and you can easily see why the momentum crowd is buying in. But let's violently pivot for a second, because a totally different narrative starts to emerge when we look at the underlying valuation. Guru Focus, which is a highly respected fundamental analysis platform, slaps a massive warning label on Valero, explicitly calling it significantly overvalued. Their proprietary baseline sits right around $145, perfectly echoing that Graham number we just talked about. According to historical multiples and fundamental data, this stock is overvalued by more than 100%, which should raise immediate alarms for anyone looking to buy and hold. So why are these valuation models flashing bright red despite such a record-breaking quarter? Well, it all comes down to the future. Analysts expect Valero to generate around $37 to $38 in earnings per share for the full year of 2026. But the projection for 2027 drops to $26.70. That is a massive 28% earnings cliff. People see a price-to-earnings ratio of 12.6 and immediately think, wow, that's cheap. But when your earnings are projected to plunge by nearly a third next year, that low multiple is actually a classic value trap. And this right here brilliantly illustrates the danger of a commodity business. Valero's gross margin is a razor-thin 4.4%. Compare that to Warren Buffett's ideal threshold of 40% for a high-quality business. A 4.4% margin basically means Valero has virtually zero pricing power. They're what we call price takers, not price makers. They buy crude oil at whatever the market dictates, and they sell refined products at whatever the market dictates. They have almost no control over their input costs or their output prices. Looking past those flashy headline earnings, we find a whole cluster of structural red flags. Deep value investors absolutely hate to see a price-to-book ratio of 3.2. That's more than double strict defensive limits. Then you've got insider ownership at a microscopic 0.39%, meaning management barely has any of their own skin in the game. For an energy stock, the dividend yield is remarkably low. And let's not forget the extreme volatility. Just one quarter before that massive $12 earnings beat, Valero earned only $3.37 a share. That's the literal definition of a roller coaster. To really understand why these metrics are jumping all over the place, we need to take a quick step back and talk about an economic moat. If you're not familiar, an economic moat is a distinct competitive advantage that protects a company's long-term profits and market share from competing firms. kind of like a medieval castle's moat, protects the fortress. It's the secret sauce that allows a company to weather storms, raise prices, and keep competitors at bay year after year. So does Valero actually have one? Guru Focus awards them a 5 out of 10, categorizing it as a solid, narrow moat, primarily because of their immense global scale, efficient distribution, and their leadership in renewable fuels. But we have to ask a much tougher question. Does a moat even exist if you literally can't raise your prices without losing your customers? Valero certainly has a cost moat because they're highly efficient, but they completely lack a pricing moat. Okay, now it's time to put Valero through the ultimate value gauntlet. We have all the data, the spectacular green flags and the deeply concerning red flags. Let's take all of this and perform our complete stock analysis using the analytical lenses of 3 of the greatest investing legends in history: Benjamin Graham, the father of deep value; Peter Lynch, the champion of growth; and Warren Buffett, the master of quality. First up, we're looking through the Benjamin Graham lens. His defensive investor checklist is notoriously strict. Does Valero have a moderate PE under 15? Yes, at 12.6 it passes. But does it have a price-to-book ratio under 1.5? No, it sits at a bloated 3.2. Most importantly, Graham demands a wide margin of safety. With Valero trading around $300, it is more than double his $144 intrinsic value calculation. The margin of safety here isn't just small, it's literally negative. So based on his rigid framework, Graham's verdict is a hard fail. We can pretty easily imagine him looking at this data and saying, the stock trades at more than double my conservative valuation, there's no margin of safety, I'm out. For a true deep value investor, buying a cyclical commodity business at double its fundamental asset value is just an absolute non-starter. Let's move over to the Peter Lynch lens. Lynch loves the concept of GARP, growth at a reasonable price. He heavily relies on the PEG ratio, which just divides the PE multiple by the company's growth rate. He wants a PEG under 1. But with Valero's earnings expected to drop 28% in 2027, the PEG ratio turns into a negative 1.83. Plus, Lynch wants to see consistent growth above 15%. Valero's projection of negative 28% completely shatters that requirement. Lynch would deliver a really swift fail here as well. His whole strategy depends on growth validating the price you pay today. Without positive forward growth to anchor that 12.6 PE multiple, the entire GARP thesis collapses. He'd likely say, the PE should match the growth rate. But here, growth is negative. I can't even calculate a meaningful PEG. I'm passing. Finally, we apply the Warren Buffett lens. Buffett is looking for a return on invested capital and return on equity consistently above 15%, which Valero's cyclical nature completely fails to guarantee. He wants gross margins above 40%. Valero is stuck at 4.4%. He demands predictable owner earnings, but Valero is up 417% one quarter and projected down 28% the next. And as we discussed, he requires a durable economic moat which simply does not exist for a price-taking commodity business. Now, Buffett would certainly appreciate that massive $4.5 billion in operating cash flow. Who wouldn't, right? He loves cash. But the fundamental lack of a pricing moat in a highly cyclical industry makes this an immediate pass. The inconsistency of the earnings and the sheer inability to dictate prices violates basically all the core tenets of his investment philosophy. When we synthesize all these insights into one final scorecard, it becomes crystal clear why Valero is the ultimate great quarter terrible stock paradox. We applied 3 vastly different analytical frameworks: deep value, GARP, and quality moat investing. And yet all 3 arrive at the exact same conclusion: a resounding fail. The stock price is simply detached from the conservative realities of the underlying business structure. So what should you actually take away from this explainer? Well, before you get swept up in the hype of a 417% earnings beat, you have to ask yourself these critical questions. Are these record refining margins actually sustainable long-term? Can the renewable diesel business grow fast enough to offset the traditional business? What happens to their bottom line when the market normalizes? And crucially, with the stock trading near its highs, is that massive 28% earnings drop in 2027 already priced into the stock, or is a painful correction waiting in the wings? I'm going to leave you with this final provocative thought. In a market that's constantly chasing the next big headline, you have to look deeper. When you strip away the flashy earnings beats and look at the actual fundamental value, you have to ask yourself, does a single quarter of explosive growth truly justify buying a stock trading at double its intrinsic value? It's a question every investor has to answer for themselves. Thanks for joining me on this explainer, and remember, always look past the headlines.